My friends and members of the Society to Advance Financial Education, welcome to this extended version of our professional investor segment. As Jeff and I talked, we're very pleased right now to be joined by a real professional who understands this world, a gentleman by the name of James DiGeorgia. I've known James now for about a year as he's a partner with Jeff in Superstock and Wall Street Rebel and the other sites, and he's got some really keen insights for you on the energy markets and the commodities markets. James, welcome to this program.
I'm glad to be with you. Thank you for inviting me.
Now, Jeff tells me that you've had some interesting discussions and articles lately on the energy sector and what's happening there with the other countries around the world. And I wondered if you'd enlighten us.
Well, basically, what we've been discussing is really the oil glut and why the oil glut developed and how it's developing and its impact on the world. Most people are aware that the gist about the oil glut that's developed in the last year and a half has been about the Saudis trying to cripple North American shale oil production. But in reality, that's only part of it. The real game afoot has been Saudi Arabia's attempt to undermine the financial infrastructure and ability of Russia, which is supplying military armaments and assistance to both Iran and Syria. So we've had a situation where they've been pointing the finger at North American shale, but really what they've been after is Russian production, trying to impact the Russian economy, which depends on oil. A lot of people remember that the Soviet Union collapsed primarily because the price of oil had dropped to as little as $10 a barrel.
Now, do you think it has something to do with Russian support for Syria and Iran?
Absolutely. And really, it's a proxy war that's being fought not only in Yemen and in Syria by forces that are armed by the Saudi oil kingdom, but also the other Sunni oil kingdoms in the region. But it's also an economic proxy war by trying to undermine the Russian economy. They've been attempting to impact Russian decision making, and this has been going on for a steady period of time, and it's a case of mutual financial destruction because while the Saudis have allowed oil with this glut to drop down to as little as $25 for crude, now it's trading between $25 and $35, so that range. It's so cheap that it's not only undermining the Russian economy, but it's also undermining the cradle-to-grave benefits that the Saudi kingdom has had in place and the other Sunni kingdoms had in place for their people in order to, reduce discontent in the kingdoms.
Let me interject a question then, because I get this from our members from time to time. If you've got Saudi production rising, you've got Iran coming out saying they're going to pump as much as they can. How in the world are oil prices rising into that supply-demand equation?
Well, first of all, the Iranian infrastructure for oil production has been so crippled by sanctions, this extended period of sanctions, that has kept investment out of Iran. So, when they claim that their target in a year is to export as much as 1 million barrels of oil, I got to take that with a grain of salt because, frankly, if you're a Indian investor or you're a Chinese investor, you're not going to invest in Iran in oil investments when the whole market is so weak. As long as oil is under $50, it really doesn't make economic sense to go ahead and invest in Iran. So that boast is really not, that target is not going to be hit. Okay. Now the other thing is that both Saudi and the Russian production is already at its max. So it's not like they can ramp it up anymore. But the reality is both of them would do better cutting their production by 600,000 or 700,000 barrels and in a cooperative way in order to buttress the price of oil over 45, perhaps $50 a barrel you would get at that. rate at the current in the current market. You got to keep in mind that over 1,000 rigs in North America have ceased producing oil. So we're looking at a time horizon of about 6 months to a year where North American production will drop by over 600,000 barrels. So if you have a situation where the Saudis and the Russians can come to an agreement on curtailing or coming up with a quota that they can both agree on, you can have a situation where you go from a big glut in oil to very quickly a undersupply and shortage of supply. And this is starting to happen. About a week ago, news came out that the Saudis were actually talking to Russians to make a $10 billion purchase for military armaments. Okay, and within a few days, they heard news came out that the Russians and the Saudis were coming to an agreement on a freeze of production at January's levels as a first step to negotiating an OPEC, non-OPEC cutback. Mm-hmm. And, anybody who's familiar with the oil market understands how complicated this is and the pressures that are on the market. Like Venezuela, for example, the Maduro government is on its last leg. There's an economic crisis taking place. Its one asset, Venezuela, is the exporting of oil. But when they nationalized their oil industry, they put themselves in the same bucket as the Iranians found themselves in with sanctions, where foreign investment just isn't coming in, and they had to rely on state investment, in their own industries, and the money just isn't there. So the Maduro government, is desperate for the type of for any cutback whatsoever. If they can reduce the overall OPEC, non-OPEC supply to the market by 1.2 million, 1.5 million barrels immediately, that $15 increase that you can expect in oil, where it gets up to $45 or $50, would come very quickly. And that incremental money, that additional $15 to $20, is the difference between the Maduro government surviving and not surviving. And it's not just Venezuela. It's also Brazil, it's Ecuador, and it's a lot of the countries in Niger, in West Africa. All these countries have production costs that are way above the Russian and the Saudi costs.
All right, let me interject a question then, because a lot of the members are going to say this to you. We're looking at $1.80 gallon gas here in Illinois, for example. If that price runs up to $40, $45 a barrel, that price will run from $1.80 up to $2.50-ish, let's say. I don't want that to happen. Most of my members don't want that to happen. Are you suggesting that it must happen for some reason that will benefit us somehow? Because I don't see it.
Well, the benefit, everything's interlocked in this economy, okay? So the fact that you have oil prices pressured so low actually threatens a lot of banks around the world that have invested in energy companies. So your investors really have a situation where they have to really think it through a little bit further than what they're actually paying at the pump. For example, it would do no investor good to have banks starting to collapse or needing to be bailed out because they've invested in energy companies, whether it was here in the United States or it's in Europe. And the reality is that in the sub-zero interest rate environment, banks are struggling in order to make a buck.
Right.
Now, the credit card companies, they make great money, Visa, MasterCard, American Express, because they're getting 16 to 25%. In interest charges. Okay.
So James, let me go back. Let me just make sure I put this in language folks will understand. Yes, the consumer spending side of the economy is benefiting from low prices, but it's come down so fast that we're having states like Alaska, Texas, Pennsylvania, and possibly financial institutions that are now put at risk because of it coming down so fast.
Absolutely. And in those states, you have, basically mini recessions that are starting to hit. And the banks that are investing in projects in Alaska, North Dakota, South Dakota, Montana, Wyoming, Texas, Louisiana, are, facing a serious problem. If oil doesn't come back, a lot of these companies are going to have to consolidate or they'll go under.
Okay, but
And
let me follow on that. If they do that, then supply will naturally contract, prices will naturally go up, and it seems like the market mechanisms will kick in, and this will all kind of work out.
let's be totally honest with everybody who's listening. The oil market is not a natural market. Okay, it is the most, other than diamonds, it's the most contrived market in the world, the most controlled market in the world by states that produce oil. For instance, trying to get a coordinated agreement that would include North American producers and South American producers in some type of, non-OPEC agreement doesn't work. The vast majority of the oil that we're dealing with that's a glut is state owned, right? We
Okay.
wouldn't have this glut if it wasn't for the fact that the Saudis are so worried about either North American shale production, competing for market share, or that they're really concerned, and I think this is their focal point, is that Russia's just dumping all kinds of armaments, in Iran and Yemen and in Syria, and they've gotten into the middle of this crisis.
So what you've got is
Sheeta.
rather than a free market, you have government controlled markets who are
Right.
using oil in ways other than an economic game. For example, Saudi
It's an
Arabia
economic weapon.
it's a weapon against the military movements on other countries.
Right, exactly. And, it's a serious situation as far as the balance of power in the world, because now for the first time, you have the Saudis actually sitting down with the Russians and trying to make the Russians dependent on their arms sales. The Russians have commodities to sell, principally oil.
Mm-hmm.
Okay. Their other big product export is military weapons. Okay. Can you imagine an economy? This is the criticism and the knock that serious economists have on the Russian economy. It's never seemed to diversify into a consumer,
Right.
oriented market. It's not producing, high tech computers. It's not contributing servers. It's not a service oriented country. It's just basically, what's left over from the old direct economy that existed in the Soviet Union. And, despite, the popularity of Putin, the reality is that that's all because of saber rattling. It's not because he's really invigorated the Russian economy. Okay, it's still dependent on oil.
So after
Okay?
this many years, Russia still has failed to build jeans and guns and butter. They're all in the gun side.
Oh, I mean that's absolutely true, and really, Putin's put himself in a situation when he started just continuing the Soviet mantra of a client state with Iran and with Syria. The Saudis view that as an ultimate threat to their survival. And really, as any Muslim will tell you that's a Sunni, that ISIS, Islamic State, ISIL, would not exist if the Assad administration didn't exist in Syria. Okay,
Okay.
that the knock on the Saudis is they're supposed to be our allies, yet they're the ones behind the scenes who have funded groups like Al Qaeda and
Yeah.
and ISIL and ISIS. Really the Sunni oil kingdoms have been using those terrorist groups as a weapon against Assad and against the theocracy that exists in Iran. And the reality of the whole situation is it comes down to dollars and cents. Unless the Russians
How true that frequently is.
get cooperation from the Saudis, right? They can't make a big enough dent in the supply of oil to actually help their economy. And the way they're going through their foreign reserves, both the Saudis and the Russians are going through their foreign reserves. They got basically 2 years of this nonsense that they may be able to survive. Okay, but in doing all this, they've set the danger of a deflationary spiral, in Europe,
Yeah.
okay, and in Japan and in Asia and even here in the United States.
Yeah, and folks, just in case you don't know, inflation at a controlled level can be good for the economy. Deflation, I don't think there's any scenario anybody wants that.
Yeah, deflation is the worst possible reality. And frankly, inflation is a very healthy thing if it's running between 2 and 3%. Okay, that's why it's the Fed target, because
Right.
what it does is it allows natural growth of an economy to take place so that you can get the job growth and you can get the GDP growth to raise revenues, reduce deficits. It's all intertwined. So when this oil drop that feels so great to consumers has been so sudden and so violent. I mean, if you had asked me a year and a half ago whether oil would go to $25 a barrel, I would be the first one to get it wrong.
Well, I think you and everybody else.
Right. Because I couldn't imagine that the Sauds would take such a gigantic step. I mean,
unless they did it right into a slowing Chinese economy, a slowing European economy. Right. So the demand side certainly slowed, and the supply just went explosive.
Right, and the point that really every investor should get is that when you have a deflationary situation like this set up, it puts the banks in trouble. And we just went through 3 years, 4 years, even after our own crisis with the European banking crisis. So We're right back in the same hole again, unless these parties can work something out. It's to the benefit of virtually every country that relies and imports oil, okay, and exports oil, okay, to have the Saudis, the Russians, the Iranians, the Syrians, and the oil kingdoms in the Middle East to come up with something negotiable. Look, just 3 years ago, 2 years ago, you had the Saudis saying that $90 oil was perfect for them. They're perfectly comfortable with it. They had no plans of making any cutbacks or increasing supply.
Yeah, I mean, we were all looking at $4 and $5 gasoline kind of as the new norm. And on an inflation-adjusted basis from the 70s, it wasn't that bad.
Right. And what changed was the Saudi king died. And you got a brand new king that came in, another member of the royal family. And his view on it was, look, the biggest threat is what's happening in Syria, what's happening in Yemen, what's happening, in other Saudi kingdoms.
Yeah, they're scared the Arab Springs could come home to them.
Right, exactly. So, the market's probably as interesting as it could be. It's like that Chinese curse, may you live in interesting times. Well, look, the oil producers are going to be living in interesting times for several years now, because until the price of oil really gets over $50 a barrel and we approach 60, 65, you're not going to see a renaissance in the United States for drilling and for shale oil, okay? And so if you're somebody who realizes that there has to be balance, you would hope that the oil supply situation rectifies itself. Now, we've seen a little rally off of the idea that there was going to be a freeze. Yeah. And, basically that was released on Tuesday. Wednesday, oil ministers from Venezuela, Ecuador, Brazil, Saudi Arabia, and the other OPEC members are meeting right now in Tehran, trying to get a foothold of a deal in place that everybody can live with. Now, personally,
James, I don't know about you, but I think this could snowball out of hand real quick, because if they do cause banking problems and they cause enough energy problems, the globe could go into a very bad recession. I mean, real quickly.
And frankly, they have something else that they have to worry about. Let's just say that the oil flutters around $35, $40 a barrel. Okay. It's not enough. It's not cheap enough that it's going to stop the solar revolution and the wind revolution. I mean, every day you look in the news and you find some guy who's built a new contraption out of their garage. Okay. Yep. The one thing that's missing is the battery technology. That's why I've always said that Tesla is really a battery company.
Right.
Okay. When you can hook your house up, okay, to a battery and to some type of solar or wind generator, what you're going to do is displace the power companies.
Right.
The power companies keep raising the minimum price that they charge a customer on a monthly basis, so that they're anticipating what's coming in technology.
So in order to get 10% of your power from the electric company, you'll still pay a full freight for it.
And meanwhile, the oil companies, the oil producers like Saudi Arabia and Russia, are not making preparations for the shift in technology that's coming.
They can't.
So really, their big years of being able to move oil into the market like we're used to, what we grew up with, is maybe only 20 years, 25 years. Okay. So if they spend the next 5 or 6 years fighting with one another and not cooperating on a export limit, they're chewing up the time at which that they're going to be able to really sell oil at a profit. Right now, the only people that are making money on oil are really the Saudis, okay, because it's an incremental amount to take it out of the ground. The Iranians cost them $90 or $100 to produce oil per barrel, okay? And most of the Sunni kingdoms are between $60 and $80 cost of production of oil. So they're busy selling it right now at $35 crude. You could see they're just doing it for the cash flow, but it's not in their economic interest.
No, that is not a long-term business strategy that will pay off.
That's right.
All
So,
right.
I tell people just to keep an eye on the situation. If, in fact, a deal is struck in Tehran and they announce that there's a cutback of, 500,000 barrels initially in total export between, by the way, non-OPEC and OPEC supply or restricted supply deal was cut 15 years ago. Okay. It lasted off and on for about 5 years, okay? Cheating went on, the deal eventually collapsed, okay? But there was demand for oil.
Right.
So that cheating really didn't affect the price. This is a deal that has to be made for the economic survival of a lot of these countries, okay? And, if Iraq keeps selling its oil at $35 a barrel, and they're not getting 35, they're getting, a discount of maybe $3-4
right.
a barrel selling their oil, they're not going to be able to have the money to fight ISIS and to keep the Peshmerga, the Kurds fighting. I mean, just today, there was an announcement that the paratroopers in Iraq, 150,000 man fighting force, is being cut by 30,000 because of the economic displacement caused by oil revenue.
You and I both know this is the beginning of that. Putin's not going to sit back and watch his country collapse. He will take military action to sustain it. So who knows? But James, this has been a great pleasure. It's the first time we've had you on for our professional investment series, and I'd like to ask if you'll come back and join us again.
Absolutely. Be glad to do it.
Well, all of us here at the Society are glad you did, and I want to thank you very personally. I know you and Jeff have done some really good work. You've got a new website, Wall Street Rebel, I think it is.
WallStreetRebel.com, and we load it up every day with editorial. It's completely free. We put some of our best ideas. We give sneak peeks to our newsletters like Superstock Investor and Golden Energy Options Trader. So it's a really slick vehicle. Works great on cell phones, on laptops, on iPads, it's easy to read. Nice big lettering.
Those little things that mean a lot. Folks, you ought to all go see Wall Street Rebel. And as I said, as we look at the SAFE investment clubs, you can understand why SAFE is using James and his friend Jeff as preferred providers to our clubs. These guys have a vast experience in turning little bits of money into more money, and that's exactly what we're looking for. So, James, thank you very much. I'm sure we'll catch you soon, and we'll be in touch.
Okay, God bless.
Thank you much. Bye-bye.
Bye-bye.